Good afternoon, morning actually, to the Professional Insight Podcast Season 6. Don't know what episode it is, and it doesn't really matter. My name's Brandon Curry. Where's everybody else? Are they popping on here? Oh, there we are.
I'm Jeff Collins.
I'm Josh Bond, and it is afternoon somewhere.
And
It's
Trevor
somewhere.
Lindy.
Well, supposedly, according to Jeff, we're huge in Australia, so this is what people
New Zealand.
Oh, New Zealand. So it's the next day, okay? But it's afternoon somewhere for a couple of our listeners. Thanks very much for everyone for tuning in and for sending questions in. So a couple of the questions, Trevor, you kind of entertained this particular question, and that was we had a bunch of questions about home equity, lines of credits, and reverse mortgages and stuff like that. And so I'd like to welcome two of our guests from HomeEquity Bank onto our podcast. Clive Koch, how's it going, sir?
It's excellent. Thank you very much for having me.
Thanks for coming on. And Deanna Lip from HomeEquity, how are you?
I'm wonderful. Thank you so much for having me.
Thanks so much for taking the time. For everyone that's listening and watching us, please feel free to put your comments and questions in the on YouTube, on Twitter, or if you have any, answering them on the fly if you come. But we did have a couple. I know, Clive, you said we could ask you guys anything, right? And you're going to answer. So, Jeff, I know you had a question, so go ahead. What was your question, Jeff?
This is the most important podcast question ever. Who will be the Leafs' next general manager?
Oh, for the time.
Who will it be, or who should it be?
Who will it be? I know who should it be, but who will it be?
It's our Brad Trivelling's already gone, right? That's who it should.
No, he's not gone yet. He's
I
the
thought he
only
went to
interviewed
Calgary.
guy so far. No, he got fired from Calgary. He left on mutual terms.
Well, that's right. Conroy went over there.
Yeah.
So this is hard-hitting stuff. You said anything, I need to know.
If I had the chance, I would probably shortlist Jeff Collins, Josh Bond, Brendan Curry, and Trevor Lindy.
No, Trevor.
No, Trevor, not Trevor.
He would tank it so bad.
He would.
He lives in the past with his hockey team, so it's
He'd get
very
abused.
current.
He'd get abused in the media.
What
He's a Habs fan.
What GM coach doesn't get abused by Leafs fans?
Well, especially if you're a vocal Habs fan and then you're the manager of the Leafs, you'd get eaten like a cub.
Well, why? Because you move up in the world, you get eaten?
Well, not just because you're a
can't
Habs
be
fan.
bad at someone bettering themselves.
Yeah, but if you're a Habs fan and you're actually the manager, I think the Toronto Maple Leaf fans would roast you every day.
So Clive and Deanna, we just need one word answer from both of you. What GM? What last name? Who you got? This is big
I
in
don't
New
know
Zealand.
any. I don't know any.
I don't have anyone because I think that job is in the city of Toronto is not an easy job to take on.
No.
It's the best job in the world if you succeed in winning a championship.
It's
You have
easier.
statues made of you.
It's
How many decades has that been?
legendize.
Never pay for a drink in North America or New Zealand again.
Montreal. You'd pay for a drink in Montreal.
100%. Montreal charge you double.
Nobody. You got nobody, guys?
I don't have anyone.
So you both lied to us right from the beginning about answering the question.
Well, I gave you a short list.
That's true. That's true. But you did include Lindy on there,
Yeah.
so
So that wasn't educated then, because Lindy is a big Habs fan. As you can see, he's super quiet.
Hilarious. It's too
Oh, he might
funny.
still be on mute. Are you still on mute, Trev?
Oh no, I'm not on
Okay.
mute.
No, he's just quiet.
Let's circle around to business at hand here. Sorry, guys.
That's okay. So, Clive and Deanna, just jump in. Doesn't really matter. So, okay, let's start with. Let's get our listeners, or maybe
Start
it's
with
Trevor.
what?
I don't know who. Maybe Trevor to explain it.
What is a reverse mortgage? Yeah, let's start there.
What is a reverse mortgage? So maybe Trev, do you want to go with this one, and then I'll have our
Well,
experts kind of answer.
Yeah,
our
like
questions.
I'll let the experts talk about their product. But definitely, what I've shared with all of you guys is, leaving Scotiabank, becoming a broker in 2015. Having maybe one conversation, two conversations a year about a reverse mortgage. Now it's 3 to 4 a month easily. Right. So Deanna's my rep for the Niagara region here. So I call on her
And
a
a
lot.
damn good rep, let's just say. Okay.
Helps-
Huh?
Thanks
You like
so
that?
much.
That was good. Yeah.
It's the support. Like there's 2 reverse mortgage companies out there. You know, and HomeEquity Bank being what I would say is the best for sure. The support that they offer us as brokers, the support that they offer for customers. Like Deanna hopped onto a Zoom meeting with me and a couple of clients the one day because I had basically laid the groundwork for them, said, here's what your options are. And they said, well, you know, we've got a few extra questions, and Deanna hopped in, you know, and had that joint call with us to kind of put the client's mind at ease so that they understood the product better.
Okay, so then can we, Clive or Deanna, doesn't matter who, do you want to just give me like a 60,000 foot view of what a reverse mortgage is?
That's high. 60,000.
30,000 feet.
Yeah.
We're on an airplane.
30,000.
We're not in space.
Okay.
What are you in a Lear there?
30,000.
Clearly not a carpenter, are you,
60,
Curry?
it's got to be 60.
No.
Okay, Deanna, did you want to go ahead?
I'll give you sort of my quick snippet. So really a reverse mortgage it allows those 55 or better to unlock some of the equity in their home for whatever reason. The biggest attraction is there's no burden of making a payment.
Okay.
They can
Ever.
choose whether they
Ever,
want to make
right?
a payment. Never.
Until
Our mortgage is repaid when the client or clients no longer live in their home as their principal residence, or they pass away, or
Okay,
they have to
so
move to a retirement or long-term care facility. So it's
Oh.
really when they no longer own or occupy the property. Our
they have
mortgage
to
is
own
due
their
and
home.
payable.
They have to own their home 100% though, right? Like no, because you guys take first on the property.
Correct. But they don't have to own the home free and clear.
you can
That
pay
is
out the
one of
first.
the correct.
Good to know.
Absolutely.
So
Yes.
what's the percentage you need of equity in a house?
Loan
Is it
to
like 50
value.
plus kind of, or?
So it really depends. So it really depends on a few things: age, property location, obviously the value of the property. It's not sort of a one size fits all from a loan to value perspective.
Mhm.
It really depends on certain criteria. How
So
we
what could you
Yep.
give us a range? Like what would be the low end on your loan to value and
It could be as low as 15% to a maximum of 55, between 55 and 59%.
Okay.
Right. You gotta,
So yeah,
sorry, you gotta
that's
think
okay.
about it, right? Bond.
Yeah.
If it starts at age 55,
100%.
and this
There's
is
a
something
lot
you
of-
never have to make a mortgage payment on again.
Yeah.
The whole idea is that HomeEquity Bank doesn't want to put themselves into a financial position
100%.
that the customer owes them more money than the house is worth down the road.
Yep.
Right. So they'll start that loan to value much lower. And another thing too, Deanna.
But that's why I was putting the question out there, Trev, right?
Yeah.
Just for the audience to know
For sure.
that don't go there with all due respect and expect to be getting 80+% loan to value on these types of mortgages, right?
Yeah, exactly. Right.
You're
and
absolutely
also,
right. Yeah.
one of the things that you didn't mention though is types of property play into it as well, right? Like you guys will give more stock to a freehold detached home than a semi-detached home than a condo, right?
In some
seen-
situations, you're
Okay.
right. You're
So
right.
it's a matrix that you plug in a bunch of
Correct.
information into, and then it
A very easy tool that's available to everyone. Absolutely.
What's the most common snapshot or profile of a person who would take advantage of this? Is like something in their mid 60s with zero mortgage on it anymore, and they just kind of like, what would you say is your highest percentage of type of people? Single person, couple?
Look, our average age customer is around 72 years old.
Okay.
okay.
And so that sort of gives you a profile as to where
Yeah.
that massive middle is of customers that we deal with.
So the
But, you know,
first time
going back-
buyer range then basically.
Yeah. But going back to the question, yeah, no kidding. Going back to the question that you said before, really, I just want for the audience to help them understand that we recognize that different market areas, the property values appreciate differently.
Mhm.
And so we'll lend more money in those market areas where the property values we know appreciate quicker or faster. And that's probably the best way for the audience that's here to sort of conceptualize how much we give. But yes, it really is not about giving 80%. And I think, Josh, it's a really good point that you're raising here.
Yeah. Well, I mean, the intention of it is to facilitate. A lot of times, retirement, right, is a main thing, right, where you're not forced to deal with that monthly expense of a mortgage payment, where you can just have it kind of accumulate and then pay it out through the asset when it comes realized, right?
Yeah, the funny thing is that we actually track a lot of data around the purposes to why a customer is taking out a reverse mortgage, what they're using their money for. There's probably 4 pretty big buckets that I could say that these borrowers use these funds for. One is, right, Josh, the first thing is to finance their retirement. That's definitely a big piece. Another one is to clear debt. And so, many people going into retirement still have debt, but they don't want to they want to stop payments. So they want to increase their cash flow, so they reduce their debt. Another is to help a family member to buy a home. So we're starting to see a lot of parents and grandparents,
especially nowadays,
children, grandchildren funds. But then the last one is for healthcare reasons, which is a very big one. Those latter stages in life are the most expensive stage of your retirement, and that's where people tap into this equity.
And we really noticed that during COVID, if I could say. I mean, who wanted to, put someone in a retirement or a care facility? Even now, based on what happened in COVID, right? So we're really, to Clive's point, we're really seeing those utilized funds for in-home health care, staying in their home, staying in their community as long as they possibly can.
So I'm assuming when you guys get this all done, there's an appraisal of some kind for the house, right? Is part of that appraisal a equity forecast of that particular house in that area and where they predict that value to go? Is that part of your appraisal?
So great question. What we give all of our customers is what we call a financial illustration. And so what that illustration says to the customer, listen, based on the amount of money that you're going to take today, based on whether your property appreciates at 1% per year, 3%, or 5%, this is what the value of your property will be. This is what the estimated balance of your mortgage would be. And this is what the remaining equity portion will be left over, Jeff. So we don't predict the future value with the appraisal, but we do give them an illustration for them to conceptualize and visualize what the impact is to their net worth position.
Now, is that a general forecasting of it, or is it, determined by specific area too?
Yeah, if either of us can buy the lottery tickets, I don't think either one of us would be here. So the thing is that we can't predict exactly where we're going to be. No one predicted the market that we're in right now, a market of higher interest rates, depressed home values. No one saw that rates were going to rise this quickly, this fast. So we don't put ourselves out there as saying this is what it will be. We just simply say, if these things happen, this is the picture that we provide to you.
So, and one thing to note here is I'll share my screen real quick. I've got a client file up in front of me. It's part of the specific document doesn't have any of their specific details in it. But basically it illustrates exactly what Clive was just talking about, the 1%, 3%, 5% value. So if I go here and then please log into what? Oh, here we go.
Can I ask a question while Trevor's loading that up? Obviously, at first blush, I understand why 55, right? Because you're trying to forecast things and you don't want to drop that bottom threshold too low. What are the odds that you will?
Oh, that's such a good question.
Great question. Because
I like the way they said your question was good, Bon. That's nice.
Well, especially in this market, right? Because there's a lot of people sub 55 that would be looking to come to the well.
I think that the age started off initially, it was before my time, at 62,
60, yeah.
and then was moved down to 55. So who knows what the future will hold in terms of there being further adjustments to the minimum age requirement. But we do know, and this is something or a situation where people get tripped up. Both of the borrowers on the deal have to be minimum 55. And sometimes this happens where in a second marriage situation, there's an age discrepancy, and we're like, okay, you qualify, but because of your partner, you don't.
So we're now also chirping. We're just chirping Trevor.
Yeah. So just to be clear, obviously, I do know where it is. I've been waiting before all of a sudden we. Yeah. Thanks very much, guys. Appreciate the quiet talk here.
I wasn't going to bring it back up, but they seem to be putting pressure on you, Trevor.
Anyways, yeah, no kidding, right?
It's a Hab fan.
Let me go.
We like the bus
Let me go like this real quick.
It's because you're a Habs fan.
Is
that what it is?
And it's San Francisco Giant fan.
You only rib the people you love, right? So
yeah, apparently that's the case.
Well, I guess what they do in South Porcupine, because I don't know about here in Niagara. We don't.
Okay, here I'm going to go like this. And then just in case it shows the other part of it, I'm just going to go and change
that
client A, reverse mortgage. And then that way it doesn't come up. So nobody sees the client's last name.
So
now we touched on spousal there. And that's something that I want to get back to because I think
I've got a bunch of questions once we
get to that point. Okay. So here we go. So we're going to go there, screen share, client A. Perfect. So this is what happens. So on this is the document that HomeEquity Bank physically sends.
What document?
So this is part of their commitment, right? So we've got full appraised value has been done on the home already. We know that the client is going to get $222,000. The interest rate.
Trevor, we can't see it.
We didn't get the screen share.
You can't see the screen share.
No.
It says that it's up. Are you serious?
I blame Rookie.
Positive.
Okay, but it says it's up and it's being shared. It's not up right now being shared?
Not yet.
It's not up right now.
It says that it's being shared. Stop screen sharing. Again, amateur hour, no kidding.
Who are you sharing it with?
Himself.
Yeah, like I've clicked on there, Studio Restream. I click on share.
He's the last one to join the podcast of the group when we formed it, just so you know. Because of this.
I'm surprised it's still not coming up. Why is it not coming up for you guys?
Well, I can create one.
Is there any way that you can just give us the verbal on it, Trev?
Or Clive could try to bring one up.
Yeah.
Clive.
I'm nominating Clive.
I think we might replace.
Have a conversation in the meantime, and
let's have an interview with Clive to replace Trevor.
I'll tell you one thing. I got in shit yesterday because I've got one clerk who's 26. I think she might be maybe 27. But we're doing Tree Fort, which is an ID verification. Anybody in the real estate world, if you haven't heard about it, I think it's through Stewart Title at this point in time. And it's an online ID verification that is going to be predominantly used for remote signings and things like that, just because identity theft and fraud. So I had one of my younger tech-savvy clerks in the office. But sure as shit, I said it loud enough so that the other ladies who are our clerks gave me the stink eye saying, like, so what are you saying about us over here? And that's not what I intended at all, but I blushed, of course, right? Like, you know what I mean? I blushed and they gave me the gears for it. And then at the end of the day, I said, okay, listen, you old hags, right?
Yeah, thanks very much there, Collins. Appreciate that. I don't even know if this is going to work. If I go here, can I share the whole screen?
So that's me putting my foot in my mouth about technology.
Is anybody seeing that now? It says right on the bottom of my screen that it is being shared. And my only option is to...
This is why Trevor doesn't produce our show anymore.
Is that what it is?
And this is why Josh never tries to share anything.
Funny, like...
I share like this. This is how I do it.
Yeah, me too.
Like, I wish you guys could see. Like, it's showing that it's in the show. It's up on the screen. It says that I'm sharing it.
Well, how about maybe we get some guidance from Rookie?
There
Boom. So it's actually up now?
Yes.
Wow.
There we go. Okay, so it was Rookie's fault, not my fault. And I'm the one getting razzed for it.
Throwing someone under the bus. Unbelievable.
Well, yeah, that's exactly what's
happening. Did you hear that, Rookie? You're getting thrown under the bus right there.
Right. So as I started to say, we've got the appraised value for the client's property came in at 506.
Yep,
We're advancing
506.
$222,000. The interest, right? It is what it is. It's not going to be the cheapest product out on the street, but
Well,
the
that's
benefit of
another
not
question.
making a payment.
But that's a question though too that I had, right? Like on interest rates, right? And that's something that should be on there. I don't know if we want to address it now, Trev, because I don't want to cut you off midway there.
Yeah, that's okay. So yeah, we'll go back to that, but
Okay.
you can see here, this is set up. It's designed. The client's not making any payments. Current age right now. So she's 76 years old, or I will use as a term, for the next 15 years. Here we go. After 5 years, we do have a projection that the interest rate is going to change, but it's for illustrative purposes. And here's what happens to the overall value of the mortgage, right? So making no payments year over year, it's going to start to climb. It starts to accelerate more with compounding, et cetera, as the time goes on. But more importantly, when you're looking at the estimated values of 1%, 3%, and 5% for increased value of the home. So right now we know that the client's property is worth 506 and they've got, basically we'll just call it $300,000 in equity. And when we're looking at the overall appreciation, as long as the appreciation value of the home is 3% or more, 15 years from now, the client is still getting, or the estate, I should say, and if, being the case, or the client, if they sell prior to, they're still getting money out of the property.
That's right.
Right.
Yep.
So, and it's kind of, again, it's part of their commitment. So the client has the ability to look at all of this and understand it. But to the point that Deanna and Clive were making, is it is a financial illustration of what they're projecting. But to Jeff's question, it's the initial appraised value today on the property. And maybe something that Clive and Deanna would like to touch on is what happens in 5 years when the mortgage is up for renewal, we'll call it.
If the interest rates are down, I guess, right?
Correct. So they would get the benefit of the lower rate. So in 5 years, nothing changes. I don't really call it a renewal just because it's a different type of mortgage. I call it a rate reset. So basically what would happen is the client would just be notified that their 5-year rate is up and this will be the new rate going forward. And that's it.
I like how Rookie downgraded Trevor to bottom right screen now. Put Deanna up.
Thank you.
Almost
No.
out. I'm almost out of the
How do I get on
show.
the
Poor
top row?
Trevor.
Yeah, Clive did nothing. I stayed where I was, but Clive did nothing.
No, you didn't.
Oh, there you go.
Clive was in the middle where you were, Jeff.
That's true.
Okay. I was bottom right.
Well, look at you moving up in the
Moving up.
world.
Woo!
Just keep
I've
beaking
got-
there, Collins, eh?
Yeah.
Pretty
the
soon
Sherpa is
you'll be
getting me moved up in the
You'll be in the
Roll here.
director's seat there pretty
yeah.
soon.
Put
Move over,
me
Curry.
top left. Screw Curry. Put me top left.
So
Yeah!
there we
Woo!
go.
Okay, I'm gone. I've been
That
Apparently
just
this
seems
is-
weird to me now, Jeff. I think you need to go back the other way. Okay, that's
I
better.
deserve bottom right.
100%.
Okay, I've got a couple of questions. All right. So we you guys both are aware
I'm pretty sure
that
we all got a few
from
questions.
from a certified financial planning background. So I do have a couple of concerns of the product. So I hope that maybe, and then that this is via mainly my clients. I know Josh and I have the same one, but I'm gonna leave the one for Josh to ask.
No,
'cause
you
that's
go.
a-
I got 3 of them
Sure.
here. You go whatever. But
Okay, so the first one is, okay, this actually happened with an extended family member of mine and also a client. In this particular case, I got to be very general as much as possible. The one of the individuals, for a variety of reasons, was just on title of the home for
trust
legal
situations. There's
Yes,
a trust.
okay? There's trust situations and legal reasons on why that's the case. That particular person that was on title went and took out another mortgage or a reverse mortgage or another product, and the other spouse did not know that had taken place. So this is a legitimate concern. It was a matrimonial home. And the concern is, how do you safeguard this from that happening? Because as you could probably appreciate, it's very common for people to have, common law relationships, marriage contracts in place, prenups. And so they can, even though it's really hard to waive the matrimonial home, to be fair, but it can be done. So how do you safeguard that from a spouse who's not on title and they have no mortgage, and then this happens? So and then the next thing you know, that spouse passes away, and the next thing you know, they're like, okay, I get the home, whatever. Oh my God, there's a mortgage on the home, on the house.
I'm going to caution you on the term spouse, because from a legal perspective, common law has no recognition in property law.
Correct.
Right. So common law spouse, out the door. You're not on title. You don't got no say.
It doesn't matter yet.
You're only talking about your married or justice of the peace.
Correct.
Church or justice of the peace married spouses.
Yes. So
are you? The question then is, how does that happen?
Or how do you safeguard it?
How do you safeguard it? That's the base thing.
Yeah.
That's the base thing.
So I can jump in on this one, Deanna. I'm going to go on the assumption that the person who applied for the mortgage is being truthful in how they represent themselves on the application. Yeah. And so what that would mean is that they're stating that they are married. If they are stating that they're married, we would automatically start to pose the question, well, where's your partner? Where are they in this transaction? And do we have their consent to proceed on what is your matrimonial home? So from our perspective in how we lend, both morally and ethically, I would say that this situation would not happen if a customer truthfully represented themselves as being married in an application. And so, because we would simply ask the question and not simply lend to one borrower that has that type of status.
We'd cover you too, because we follow that up. We follow that question up on the registration. If it's done externally, right? It's a requirement that any married spouse on the actual registration assert their spousal status, right? So if they say, I am not a spouse, who am I to challenge that person if they're the only individual on title and they're giving me a representation that they are not a married spouse? So essentially, the only way, Curry, that I've seen that happen in the married situation where they're not on title is a misrepresentation.
Yeah.
And absolutely. If I could just add, even though they're not on title with HomeEquity Bank, we need to know the details of the spouse, specifically how old they are. We will only lend based on the lower quote of them together or the titled spouse.
But now for qualification purposes, it's not only the titled spouse that has to be 55, it's also the qualifying spouse as well.
Absolutely. Yeah. Because, if you fast forward.
Yeah, collectively.
We want to make certain that in the event that one individual passes away, that the other individual can stay in the property and to continue to live on. If we overexpose ourselves with how much we lend, and then that person passes away, well, now we compromise the other surviving spouse because they don't have enough money to qualify for the mortgage.
Yep.
Right? Okay, so then
it's a fine dance, right? It's got to be a fine dance.
But here's another question for you. Okay, so now, which is very common, secondary marriages, right, or second relationships. So in the province of Ontario,
does this mean you got like two?
I got another third one too, but yeah.
Jeez,
but like
Murphy, I have a hard time with one.
I know, but so okay, that's good. That basically the only way to answer that question, my first question was, hey, fraudulent misrepresentation happens.
Yeah.
Right. But you do take measures in order to protect from fraudulent misrepresentation. Perfect. You have different safeguards, but at the end of the day, if people want to be fraudulent, it unfortunately is just a situation.
Well, they'll
Okay,
get caught
I think-
eventually sometimes, right? Like, you know what
yeah,
I mean? And then it's fraud. Like, you know,
I accept that.
it's a fraudulent conveyance. So it's not light, right? Like
I accept, yep. Yeah, no, I accept that. So the other question that I have is, you know, secondary relationships, marriages are fairly common now. Okay, so here's the situation. Either this person is widowed or this person is divorced, doesn't matter. Goes and they're, you know, after 55, they can legally say that they are not married and this is my home, free and clear. I'm doing a reverse mortgage. But in that meantime, they get in with a serious relationship. It is common law. However, in the province of Ontario, after 3 years, you can start to accrue or take an interest in property rights. Now, in this particular situation, for whatever reason, this common law spouse wants to make claim to this particular principal residence for whatever reason. Okay, maybe it's left to them in the will. It doesn't really matter. So this particular, the widowed spouse who took out the home equity had already had the home equity through HomeEquity Bank, the reverse mortgage. The common law spouse was not aware, right? And that's very common, right?
Yep.
That spouse, the widowed spouse initially, the one who took out the loan, dies. They go to, great, okay, well, you know, sad, whatever. The house goes to me as per the will, and then bam, they have this. What happens in that particular situation?
Yeah, so another great question and a unique scenario again. So in these types of situations, the way that we handle the mortgage is the same way that any traditional Schedule 1 bank would handle a mortgage. And so we know that in the province of Ontario, in Canada, people who have passed on cannot own a mortgage or have a mortgage. So the property would then go to the individual's estate, and their estate would need to settle up how this is managed. So they'd be working with our bank over a certain period of time to settle up the estate. And the main thing for us is that they stay in communication with us as to what their plans are with regards to the property. Now, all that our bank is concerned with is within a specific time frame, we're looking for the mortgage to be paid in full. Okay? What the estate does or how the estate gets there, if the surviving spouse wants to take their own mortgage to pay this one off, if they want to qualify for a reverse mortgage, all of those are options. But for us, in our perspective, all that we simply need is someone to settle and pay off our mortgage.
So essentially, if I can chime in, and I might derail this thing a little bit, but my opinion is, if I'm understanding your question correctly, Brandon, the common law spouse can get screwed.
Yes.
Right. Yeah. So if that's the title spouse owns the property, they're the only ones that can commit that property. So it's their decision. The common law spouse doesn't have any entitlements there. So they've legally entered into this relationship for a reverse mortgage. It's completely incumbent upon them what they do with their asset, right? Is there a possibility for there to be a dependent relief claim or something like that? I'm not a family law lawyer, you guys know that, but there are some rights that common law spouses can get. They rank, in my opinion, they would rank subordinate to any monies that are owed to a reverse mortgage. So in settling that estate, the first obligation would be, as it relates to this property, you have to settle the debts of that estate, like every other mortgage, right? If it had a mortgage of, you know, from Royal or TD or anywhere outstanding against it, that's all that they'd be able to do is deal with the equity in that property, unless they at some point in time take title to it and then reapply.
Yeah, we know that property taxes, liens go first, then the mortgage, then
there shouldn't be any liens because it should be searched prior to, and at the point of registration, it should be lien free. Now, there are some super priorities with respect to taxation and stuff like that that can rank in priority to you. But as a secured creditor in a first position, you're usually pretty strong, right? The common law spouse is the person who doesn't have any security in the situation.
No, and it just reiterates, because I think nowadays, I think a lot of people are reluctant to have those financial conversations when they get into relationships, and they enter into and it's one of the number one reasons why people get divorced. And
common law spouses, definitely. There's a different element if you're common law. And look, I'm not no holy roller or saying you got to go out and get a piece of paper. That's not my shtick. You do what you want, right? But when it comes to your rights, there is a material difference between being married and being a common law spouse.
Absolutely. No, these are just good questions, because these are questions that like have come up, and I'm glad that you guys are taking safeguards. You're doing the best that you can.
Mm-hmm.
And at the end of the day, to Josh's point, like, hey, common law is common law. Like, at the end of the day, it's not the same equality as being married.
It's pretty close. It's coming, right?
But it's coming, but not, but when it comes to property, every province is completely different.
Yeah.
So the other, I guess, my last piece, because Deanna, you alluded to, you don't have to make a payment, right? Which
Correct.
is very right. But are we talking simple interest? Are we talking compounding interest? I don't make a payment, and then let's say interest rates keep going up and up and up, right? Which they have, in the last couple of years. Then it comes time to, at what point is there a
who's the guilty one? Who's the guilty one?
I don't know. The one with the big
You know what I
smile
mean?
on his face, maybe? Is it? Or is it Trevor?
No, it's not me.
He's trying to
For
share
what?
your screen.
Oh. Sorry, we digress. Go ahead.
Yes.
No problem. So yeah, just what is the interest? How does it work? What's the ceiling that needs to be hit in order for that to happen?
There is no ceiling, believe it or not. So, and Clive can jump in if I'm wrong, but no, to my understanding, there is no ceiling. And as far as how it's compounded, no different than any other traditional Schedule 1 bank.
Half yearly.
Okay.
Usually.
Yeah.
Semi-annual.
Semi-annually.
Semi-annually?
Yeah. Yeah.
Okay.
Half yearly, isn't that semi-annually?
Half yearly.
Yeah. That's their term sometimes, right? Half yearly, not advance.
Oh. Okay.
The one thing
Lawyers
I
speak
want
is
to
what's
say,
happening.
Bank.
So
speak.
what happens then, Deanna, if I can, or Clive? So this person's 55 years old, let's say. I mean, you can do it a bit younger, but let's just use this assumption. The average life expectancy is around, 85, 86 for a man, 87, 88 for a female. So we're talking a solid, 30 plus years.
Are we at that high now in the late 80s?
I was going to say, I thought it was 70s.
I thought it was
No.
78 and 82.
oh, it's
70s.
higher. It's
Oh,
higher.
wow.
for
Oh,
sure.
No.
Who wants to live that long?
FP Canada has mandated that we have to do all financial plans to 90
90.
at a
Yeah.
minimum.
Yes. Well, statistically, we know that if in a dual couple scenario, there's a 50% chance that one will live over 90 years old.
Yeah.
If they both get to a certain age. So
Yeah.
you're absolutely right. Here's the
How
thing.
many of that is the wife and how many of that's the man?
95.5.
Do I have to answer that?
Yeah, it's all female.
I'm not
Which
touching
I
that
don't,
with a
which
10
I don't understand, because you guys suck the life out of us. So I don't understand that
Oh.
personally. Sorry, I had to
Well,
say
you can
it.
say, have you?
We're just
say-
we're too simple
but
a
let me leave
creature,
this-
right?
Let me leave this here. Have you watched the movie Jackass?
I haven't.
And let me know how many females are doing any of those stunts. 0.
Okay.
That's why we have a shorter life expectancy, because we're idiots.
Ours would probably
We're
be
sports fans.
if there was less women, we'd probably be even shorter.
100%. We'd kill each other.
We'd kill each other.
So my friend, hear this on this topic. Payments are optional.
Okay.
We often say no payments, but we do have a very small percentage of customers that actually do make payments.
Okay.
They make payments or interest payments, particularly if they use the funds for investment purposes and they want to write off the interest.
Okay.
My suggestion is that they speak with an accountant and get proper taxation legal advice around this. But there are people that use the product for investment purposes.
So let's say I wanted to buy a property, another
Mhm.
secondary property, and I was 55 years old.
Yep.
And I wanted to take the equity out of my house to fund or partially fund that.
Yes.
Good question.
Those are the situations that
I'm
you're
saying
probably
that
dealing with, right?
the interest that is compounded semi-annually on the mortgage or half yearly
Yeah,
is
can write it
tax
off.
deductible.
Yeah.
Is my point. When people we have on our books, Brandon, people who are actually over 100 years old. We have several 100-year plus customers. And the one thing that I would say about that is this. The reason why that illustration that Trevor showed earlier on, where there was still equity left over, is because the mortgage is being compounded at a balance down here, but the property is being appreciated on a value up here.
Mhm.
So as the mortgage is growing, so is the property value over time. And that's where the magic happens at leaving some equity in the position, in the property for the estate for the borrower.
Now, I was reading something, I believe, and maybe I was chatting with Trevor, but there's some sort of insurance that you guys, insurance, if you want to call it, with your product, correct?
Like a CMHC?
No. I mean,
So
Title
an
insurance.
assurance,
no, what I
is it
mean
the
by
Like a
no
guarantee?
negative equity guarantee?
that's it.
Okay.
Can you explain? Because I went on your website before. I know, look at me doing research. That's
Awesome.
crazy.
But that's a
Now,
huge point, I think, right?
That's a
I think
huge
it's
point.
It's
You
very
have to really
important
drive
for
because
people to know.
this
Yeah.
is unique to only HomeEquity Bank. Am I correct?
It's unique to the reverse mortgage space.
I've never seen
Correct.
it outside the reverse
I
mortgage.
haven't seen it
You
outside.
got it.
No.
Outside reverse mortgage space. You got it.
So
Yeah.
take it away, Clive or Deanna.
Well,
Don't let me
and
do it.
also, sorry, before they get into it, also Canada, reverse mortgage, different countries, totally different animal. This is specific to reverse mortgages in Canada.
Is it
Now,
federal? Is it federal or provincial?
Federal,
Banking's
it's Schedule
federal.
1 bank.
Well, federal.
it's a
is
Schedule One
banking's
bank.
federal.
So, but and then before, let me just get the listeners and the viewers up to speed. So here's the situation: 55. This is where I was leading to. 55-year-old takes it out, owns the thing, doesn't make a payment. Interest rates stay high, and in 30 years' time, this person passes away. At around that same time, we have a 2022 situation where housing prices also drop. 10 to 20% in the city of Toronto. Let's as an example. But HomeEquity Bank, I saw this on your website. I didn't see it on any other of your competitors. So can you just go and your no negative guarantee? So go ahead.
No negative equity.
Correct.
That's it.
So in your situation that you just described, in that situation, as long as the property is sold at fair market value, but there's more owing on our mortgage, we will never go after the estate for the difference.
That's
huge.
crazy.
That's
Now,
a big
is there
thing.
Fair market
something?
value. I just
Yeah,
want
yeah.
to point out fair market value.
No, of
Right?
course.
Yeah.
As
they have
determined
to-
by what? Two appraisals or?
Yeah, how do you determine that?
Now, do these people have to upkeep their house? Like, can they let their roof go to hell? Can they let the
No.
furnace die? Can they let the
It's
AC
no
die? The
different
windows?
than any other mortgage. So again, we're a Schedule 1 bank, no different than Scotiabank or BMO. And when you take a mortgage out with those institutions, you're committing to keeping the property in great condition. So it's no different.
Home
It's a
equity
good point.
does
It's a
only
good
reverse?
point, Jeff, because we should
Mhm.
talk about how a mortgage can go in default. Because people think that a reverse mortgage can't go in default. It actually can.
Go ahead. Yeah,
Yeah.
please, Clive. Go
Take
ahead.
the floor, Clive.
So, Deanna, did you want me to?
You can. I mean, I'll just very simply highlight the top three. Property taxes go in arrears, home insurance is lapsed, and condo fees are in arrears.
Okay.
Clive, you can expand on that.
Yeah, those are the main pieces. But the soft sort of pieces is that the borrower does need to continue to live in the property as their principal residence. This is a big thing. So we do take into account snowbirds, and we have a definition of what principal residence means in terms of 6 months plus a day.
Yep.
6 months plus a day, but they do need to live in the property as their principal residence. And lastly, they do commit to upkeep the property, and so not let it get into a dilapidated state.
So now what if you're in a situation where you don't follow up on that dilapidated state? Like a lot of banks don't. With all due respect, you don't have the cost to police these things, right? And you're in a situation like my friend Curry has explained, and you're at a point where you're realizing now, and the place is dilapidated, and your actual realization on it is only 80% of what fair market value for the property ought to have been had it have been maintained properly. What's the play there?
Well, as with any, the business of lending money has risk attached to it.
100%.
For any lender.
Yep.
There's no such thing as a guaranteed return on any scenario. And so we have built into our models a process. And there's a lot of things that we actually look at, Josh, to help us determine
100%.
The likelihood that a property would get to a dilapidated state in terms of how do they manage their credit, what's their cash flow like. All of these are elements that we look at the time of assessment.
But the difficulty, and I don't know if you're encountering this within your organization, but a lot of people are, employees aren't, vetting shit the way they used to vet, right? So they're not getting that nice screenshot and that nice schematic representation for us that, we used to be trustworthy. I guess that's why I'm a little bit.
Here's what I can share with you. So we've been lending money in the reverse mortgage space for over 37 years. The benefit that has given us is the ability to have data.
Mm-hmm.
And so when we've had a situation whereby, let's say that a deal fell by the wayside, we have the history of the data to actually go back and to say, what were the variables in this situation? So now we can do that look back check and
learn from our mistake, eh?
Exactly. And then we will make those adjustments in terms of how we lend moving forward.
Yeah. I'm sure you've got some insurances to back you guys for defaulted products and stuff like that too.
Let me ask you this then. Say you have a prototypical investor in this, or someone who wants to take it, who's 70 years old, right? You get an appraisal on the property. You find out the effective age of the roof is maybe it's got 2 years left. You've got windows that have 3 years left. You've got a furnace and AC that are way past that and all that. You've got a gentleman, I'm assuming you take some kind of test on their health to find out, like if they're nothing like that, if they're terminal or anything like that, and they're trying to,
Colin, can I chime in just for,
doesn't matter to them, right?
Well, on an appraisal, just to note that an appraiser will give us an economic life of the property. They don't actually give us an economic life of roof, furnace, AC. They'll rate it in different levels of condition: poor, fair, average, or superior. Mm-hmm. So they'll check one of those boxes. And a great example example to use is the one that I brought up the screen share for earlier. What happened in that case was the appraiser went out. The appraiser made note that there was some kind of cracking in the foundation. It's actually just cracking in the parging. Mm-hmm. But the reason you saw the 222 advance is it's actually for 222.5. We're holding back $500. The quote was $400 to do the parging. Client's going to go get the parging work done. HomeEquity Bank is going to release through the lawyer after the fact.
Who was the parger? I need a parger.
I can give you that off.
Yeah, send me that. Very good too.
I've got a couple that I can give you. So yeah, that's exactly what'll happen.
So if the appraiser goes out and they say, look, we look like there's $35,000 to $50,000 worth of renovations that are badly needed within the next 5 years, is that noted on the account? Because that could be a reason they're taking the money out.
Yeah, absolutely. But we'll still look at it, and is there immediate need? And we would hold back funds, so we wouldn't release everything until let's say the roof is dire. We'll hold back that amount. The client would get a quote, and then we'll release it once it's done.
And okay, so it is you're protecting it then.
We're protecting,
like another great thing about this product too is like this mortgage that I have funding next week. it'll fund, but in 5 years time, if client A wants more money, well, we can look at doing a new appraisal. We can see, is there value there? Oh, it's to do work on the house, it's to do a roof, it's to do a furnace. As long as all those boxes are getting checked and there's equity there, it's something we can do. There, people do refinance
100%.
reverse
And,
mortgages.
and if,
It is a
say, 3-4
possibility.
years from now, there's a huge jump in market value all of a sudden, can they reassess it at that point too? Like, say there's a 25% increase 1 year.
Absolutely. With the value, and especially as you get older, we lend more.
Yeah.
It's crazy how quickly an hour goes, eh?
I can't believe it.
Now, we still have a few questions. We
Yeah,
want to be
absolutely.
respectful of your
No.
time. One little bit pointed question that I've got is, we've never spoken about term. So what can you tell me about term, and whether the individual has the ability to pay off all of it, and what can trigger that, and are there penalties or anything like that on behalf of the borrower? That's kind of loaded, right? I'm all over the place.
I noticed that Deanna's
Very
being
all
quiet,
over the
so that
place.
means that's my cue that she wants
You
me
can
to
go
answer
ahead.
this.
I've done all the talking.
My
Go
question
ahead.
is, my primary question is, apart from the realization of the property on death or sale, what is the term of it vis-a-vis the borrower's perspective in terms of what options they have to pay this thing off?
No, it's a good question, Josh, and it's a question that should always be answered. And whenever someone is considering going down the road of looking at a reverse mortgage, you always want to look at, if I decide to exit the product, number one,
Any mortgage, Clive, how do I get out of this?
yeah,
Right?
can I get out of
Yes.
it?
Yep.
And if I do decide to get out of it, what are the costs to get out of it?
Correct.
And is there any restrictions on when I can get out of it? So
Yes.
really good questions. You can get out of a reverse mortgage anytime that you choose to.
Okay.
We have a prepayment structure that we have in place today that the borrower would be exposed to, no different than a prepayment structure with any other mortgage.
Okay.
And the other thing that I would state on this is, the longer you hold the product, the less expensive it is to exit. And so for us, the sweet spot is around 3 years, because after 3 years, it becomes really simple in terms of how to exit the product from a cost perspective.
Gotcha. But within that 3 years, probably not advisable. Or so much so advisable.
If it's within the 3 years, and maybe this is the perfect time for us to explain and share with you and the whole audience, we actually have 4 reverse mortgage products, 4 of them.
Okay.
So one gives a lump sum, one pays an annuity to a borrower, one gives a higher loan to value, and one is a fully open product.
Good.
So
I'm glad that you went through
we
that.
call them CHIP,
Yep.
Income Advantage, CHIP Max, CHIP Open. And they're all catered around suitability and based on the customer's situation. And you marry up the customer's situation to the type of product that's available.
Now, when you say the penalty is very similar to other mortgages, the penalties can be 2 months on some mortgages or 3 months, and they can be interest differential.
Well, it depends on the
Which one is
product
it
that
more
they
similar
choose,
to?
right?
Yeah.
Yeah, that's exactly. Depends on the product that they choose, because a CHIP open product has no prepayment penalty at all.
Same as an open mortgage, right?
Now, I love the happy stuff and all that. What's the worst case scenario interest payback or penalty?
Worst case scenario is someone who takes a mortgage on day one and then decides to pay it off on day 2. That's
because
the
they won the
worst
lottery.
case scenario.
They're not going to care. Yeah.
However, if the reason why this mortgage is being paid off is because the last person on title has passed away, under that scenario, we waive the prepayment penalty.
Got it.
Okay.
Okay,
So
that was okay.
it's
You
a
kind
very
of jumped
important
into the
thing to
question.
know.
Perfect.
Yeah, that is. Like, so if you've got joint tenants on it and one of the joint tenants passes away?
Only when the last one
Last
passes
of the
away.
joint tenants. Okay.
Right.
So when you're
Correct.
realizing the estate,
Correct.
you
Sure.
don't
And when we
penalize it.
Yeah, and when we look at a reverse mortgage, it's not necessarily it may not be suitable for someone who's looking for something short term.
Well,
It
it's
could
not for
be,
everybody, right? It's
and
not for
it's not for
everybody.
everybody, but it's really someone who, let's say, is just in retirement, or they've, you know what, they've lived longer than expected, they've outlived their savings,
Yep.
or they're drawing down too much from their investment to maintain their lifestyle, and there's a tax implication to it. These funds are tax free. So when we look at the product itself, we look at, I always say it's almost a 5-year commitment. Usually it's longer, and our mortgages, correct me if I'm wrong, but our mortgages really stay on our books for about 7 years. So when you think about that for the need and also the accrued interest based on the financial illustration,
Yeah. Well, it makes sense.
not
So if you
bad.
say your average is 72 and our
Mhm,
average life expect, I thought it was around 80, right?
mhm.
That's 72 to 7 puts you around 80 years
Lines
old,
up.
right?
Yeah.
Yeah.
Yeah, depending on
And
what
then
you're looking at here, just a real quick average life expectancy in Canada. This is an article from March 17th, 2023. Life expectancy for men is 79.49 years. Women is 83.9
Holy
years.
man.
well, yeah, but that's after COVID though. So you have to go with pre-COVID numbers,
Yeah,
and
it's
pre-COVID
probably
numbers,
better,
it's
eh?
higher. It's better.
Yeah, like here,
Yeah.
if I go to
Here's a pointed
COVID.
question to you.
macro data. Anyways,
What's
And
your
where
percentage? What's your percentage on loss? Have there been loss? And if so, what's your percentage?
Yeah, as I mentioned before, you can't lend money and not incur loss.
Well, you can't. You said at the
regardless
beginning,
of where you are,
you're
right?
talking
Like,
about singles, doubles. You can't hit a home run every time, right?
You can't hit a home run every time. Sometimes
Unless
it's
you're
just a
looking at the
bunt.
pitch, like
Yeah,
Aaron
just
Judge
It's just
looking
a
over.
bunt, right? And sometimes you're warming up and you never get into the batter's box. But here's the thing.
Maybe that's Manoa pretty soon if he doesn't smarten up.
Yeah,
Be-
right.
Yeah, no kidding. Because we are very ethical and moral in how we lend our money, that translates into a very low provisions for credit loss in our world.
Yeah.
Because what that means is we want there to be equity at the end of the loan for the estate.
Well, you're trying to
And so we-
facilitate it, right? And I think you guys sometimes out there, you don't have as clear a message, right? And that's part of getting you on here and trying to get some exposure, because we think there's some good value in this product here, right?
Well,
The
we hope
education
you-
is huge. Education is huge.
And we hope
I feel
you'll
better
have
about
us
it or
on again.
recommending it now.
We hope you'll have us on again. I mean, I think
Absolutely.
that this is a great conversation, and it should generate some more questions from you. But in reality, in Canada, 47% of Canadians over the age of 55 own property.
Yeah.
So
Well,
virtually
like-
one in every other person over the age of 55 own property.
See, my interesting
there's
scenario
equity
about
there.
this would be like for a parent of my parents, basically, right? Rather than them holding on to all their money and the equity and all that, and hoping to pass it on to me when they're passed, I would rather push them to take advantage of something like this, so they could travel for
100%.
the next 10 years, right? And not worry about, oh, I'm a pensioner now and I got no money and I'd love to go to Europe, or I'd love to go to New Zealand and meet all our podcast, groupies and stuff like that. But
not all kids are nice like Jeff, though, and
could
want to
do
take
it.
care of their parents.
Well,
Right?
for sure. But you know what? Like don't save your money. Like I'm doing all right.
Spend it.
Like don't save your money for me and all
Spend
that.
it.
Enjoy it, because when they pass away, a lot of it might be taxed anyways before I get it.
Right.
So screw it. Take advantage of it.
Now,
Enjoy
if you talk to us first.
your golden years, more or less, right? And have some great experiences before
and Jeff, it's
inevitable
funny.
happens.
That's
I think it's a
something
great
that
product for it.
I'm seeing a lot of the conversations I'm having with clients right now is just that. Like, they're getting to that retirement point and realizing, you know what, I didn't meet with a financial advisor early enough in life to plan for retirement. So now I need these products. More and more people are getting to retirement and still having a mortgage, right? So now they're in that position and it's like, what do I do? I'm on a fixed budget now, fixed income coming in. So we start talking reverse mortgages. And one of the biggest struggles that I have when I'm having the conversation with the reverse mortgage is usually the kids getting involved in the conversation. And the kids are like, well, the interest rate on that product is too high. It's like, well, hold on. Mom and dad don't have to make these mortgage payments anymore. So sometimes I almost want to sit around and have a conversation and say, unless you're willing to make mom and dad's mortgage payments, maybe you should shut up and take a back seat to this conversation.
They're worried about their inheritance.
That is huge. The amount of people, the amount of kids that I deal with, or because maybe it comes as a kid's referral, that they're worried about what their inheritance is going to be. It's like, dude, let your parents burn the house to the ground,
100%.
Not literally the house to the ground, but spend their money, enjoy it. They worked their whole life for it. Like,
well, and
it might
even extend their lifespan by having great experiences and traveling and stuff like that, rather than being stressed out and sitting there. And I think a big thing with is the older people, they have a timeline before they think they can't go on a plane anymore.
Yes.
Right?
Yeah.
They're like, I'm 84 now. I can't get on a plane anymore. Or I have COPD now and I don't want to go on a plane anymore. You know what? Go take some money. And live life. Go see shit you've never seen before. Like I went to New York this weekend. I'm 46, first time ever going there, really having fun. And now I can't wait to go to Vegas or we're planning a Europe trip and all that. But my parents thinking, it's too late in life now. I can't do it. So bullshit. Go get some money. Go do it. I don't need your money. And the equity that you're going to gain on the house anyways is basically going to cover the difference of the money you're borrowing right now to enjoy life now. You know, to me, it's sensible product somewhat.
And Trevor brings up a really really good point when dealing with children. And it all, again, I'm going to go back to the education piece. There's so many misconceptions about, oh, they're going to drain all the equity and there's going to be nothing left.
Yes.
That's not the case. So if you can sit and have a conversation and show them, that's why the financial.
That's the education piece that you got to get out there, Deanna.
100%. We're trying, trust me. I mean, but it really is that they have a preconceived notion of what it is, and when they realize it's not, and you know what, their parents are going to live comfortably because they have worked their whole life. They've probably already helped their children out with
Oh yeah.
a school, a wedding, maybe a divorce. I don't know, whatever.
Bail.
So here's bail. I was going to say that because I had a client like that.
Help them with their mortgage.
Yeah.
Well, help them with the down payment. That's a big.
No, help them with their mortgages right now because there's a lot of people are stretched, right?
Yeah,
absolutely.
Yep. When you think about our clients who are 60, 65 and they haven't maybe saved enough, CPP, OAS, private pensions have fallen by the wayside. So it really is savings, and CPP and OAS are
But realistically, the baby boomers, most of them, the philosophy before the 60s was my house is my retirement, right? So what your product is doing is just I just spat on the screen.
You're dipping into it early. That's it.
Yeah.
You're dipping in early, right?
You're facilitating it, right?
You're right. And you can't eat a brick, right? So to that point, it really is.
It's like telling your children, you know what? I'm going to die one day. You're going to get some money from me, but I'd rather give you $100,000 and watch you enjoy it while I'm alive.
100%.
Yeah. Same thing for a parent doing it. Here you go. Take the money now. Enjoy your life.
Yeah.
Show me some stories of stuff, right?
Yeah.
Sometimes the parent might want to take the money out and give it to the kids to watch them enjoy it too while they're alive.
Well, family's the toughest roadblock for most people to get through. It's like in real estate, right? Like one of my biggest problems in real estate, I have to deal with the parents who haven't bought a house in 30 years and they're telling me about values about buying a house right now.
Are you talking to me?
Well, no, you're good. And you're like, well, when we bought a house, it was $45,000 and now we're paying for it. I'm like, well, no, come. Let's go around for a week and I'll show you houses and I'll show you what values are right there. And it's still one of the best investments. And you're showing me right now that HomeEquity Bank is banking on the equity gained by the people saying, we know the house is going to go up, but it's going to cover it or we're not going to take a loss on it. Mm-hmm. So enjoy the equity, your future equity now, right? Yep. Makes sense. It's great.
We do purchases, by the way. We do purchases, by the way.
Yeah. Jeff, you bring up a really good point on.
Can I move back to the top square now then? I got good points?
No.
I'm winning.
No.
You're on the top row. I don't even know how the hell you got on the top row.
Oh, now he's on the bottom. Now he's on the bottom.
There you go.
One thing I want to raise about what Jeff raised earlier about speaking with your parents is there really is a difference between dealing with someone who's 55 versus 75 versus 85. There's a difference in their adoption of technology. There's a difference in the terms and language that they use. We know we have something called the seniors code. We know that when a customer says to us, "Take your time," we know it means that they're in a hurry, in a rush. So you will get to learn and understand. And us, from speaking with so many of these clients over such a long period of time, we start to learn the nuances in around what they're looking for based on their age, based on what their focus is, based on what their health is when they apply for a mortgage.
So keeping it just I want to make sure that we're respectful of your time, because we are way over the hour that we promised, that, which is great.
Oh, I think it was 45 minutes. I think we blew that by half an hour
That's
already.
okay.
Oh yeah, like it's been
We
crazy.
thought we were going to be boring, so
No,
yeah.
hell
no.
I know an ice
You know
cream
what,
truck
Rookie,
is going to
put-
come to my house in about 15 minutes. So
Yeah.
Rookie, put Clive
I'll
in
be
the
good.
top row. Put Clive in the top row. He'll stay longer.
So as before we
There you go.
go, but before we
You
go,
gotta put Lindy down though. That's not. He can't be top row.
I'm all
Before
good.
we-
I
Can't be top row.
have no questions. You've answered all of mine. Thank you very much, and done so well. So
One thing
No,
I want
and-
to touch on just quickly
Go
is
ahead. Yeah.
one of the most common questions I get asked about a reverse mortgage is whether or not you can make payments. And they already touched on it. Absolutely, they can. There's 3 different payment options, if I remember correctly.
might depend on the product that you're in, though, right?
Well, the
Well-
funny part is when people do ask the question about being able to make payments, my response is you can, but if you want to make payments, this may not be the best product for you.
Okay.
Correct.
Right? Just the borrowing cost.
Yes.
The borrowing cost is so much more with this. Like, it has a niche market. And if you want to make the mortgage payments, whether it be an interest only payment, which is one of the options with the reverse mortgage,
Yeah.
or a blended principal and interest payment, it's like, well, there are other avenues that you can look at. So let's
Like a
have
HELOC
that conversation.
something, right? But
A
it might be
HELOC.
simpler.
Yep.
It might be
And-
simpler for qualification and this and that,
Yeah.
right?
But
Yes.
some people ask, they really don't want to, but they want the comfort there. They want to be comfortable knowing that if they did want to, for 12 months, put $500 down or $1,000 down, they want to feel comfortable that that's an option for them, but they may never utilize it. It's like those that ask for a 20% prepayment.
Yeah.
We know they're never going to
Yeah.
utilize 20%.
Canadians ask for that all the
1%.
time and
It's-
have a very low prepayment adoption rate.
But
It's funny, like
Yeah.
Scotia, Clive, Deanna, and I are all former Scotia bankers. Like,
Okay.
by
Nice.
default, the file would be 15 plus 15 prepayment privileges. But the amount of times that we as sales professionals would have it populate or come in and be like, hey, I want the 20 plus 20. It's like, why? The client's not going to use it. But if it makes them happy to see the 20 plus 20 on their
Correct.
commitment, fine, we'll give it
Yeah.
to them.
Never mind. It's a 15 plus 15 plus a double up, right?
Yes. Yes.
So I
you
mean,
got it.
realistically, like,
So let me sound cryptic here at all. A no-brainer for someone taking this product would be if you have a house, you have no mortgage, and you have no children or family to leave anything to, take the money and enjoy life at this point, right? Because you're
well, not even if you don't have a mortgage. If
No.
you have equity,
well, whatever. You know what I mean, though,
Yeah,
right?
yeah.
But if you have someone who you got you have no children or anything like that, or anybody who you're really leaving it to, like, go grab the money as quick as you can and start living life as best you can.
Or even if you do have children, is it okay to leave them 500,000 instead of $1 million?
Yes.
It's okay to leave them nothing because you took care of them for their
100%.
whole life as it is, right?
Inheritance is a gift, not
Or
a
take
given.
the money and go on a vacation with them, if you wanted to enjoy it and have some great times, like it's interesting. Huh.
Yep.
And remember, we're talking about a small.
yes.
We're very conservative on what we lend, so it's
Yes.
not like we're lending 80%. So we
No.
have to put it
No.
into perspective also.
100%.
Yeah.
100%.
Yeah, more than likely you're covered just on equity gain anyways, right?
Another thing I'll quickly touch on is to everybody's point. It doesn't have to be mortgage free, but as long as there's enough equity in the home that HomeEquity Bank can wipe out any first charge.
Can you
It still
screen
has
share
to
that
fit
for
the
us?
matrix. It still has to fit the matrix too.
Yeah,
right?
like-
because there's other factors that go into that. You can't say I've got a $500,000 loan. I'm 70 years old. You know what I mean? The amount that you might
But
authorize
basically,
that
no,
person
but
is
again,
maybe
it
for
just,
510,
if we,
right?
yeah, but just, I think it just reiterates what we've been saying before. Go talk to a mortgage professional, talk to someone that you can trust, and run the numbers. And then if you need a second opinion with a financial planner or a financial advisor, by all means, have them run it too. This has happened to me where they come in with their spreadsheet and like, they're like, does this make sense? And then we kind of go through it all, right? And but it's just, you don't willy-nilly to something like this, but to, and make sure you deal with the good companies that, really take your situation into account and really, do their due diligence on
Just
what's
talk to
required.
Professional Insight. We'll tell you who to talk
That's
to.
it. The axiom for today is if you've got a home and you're over 55, odds are you could have access to cash.
Can you guys do this in New Zealand where we're big? We get you lots of business.
Tons.
Is it
New Zealand
Kiwis?
as well.
New Zealand Kiwis? They love us
I'd
out
like to
there.
make the trip. So I'm
Yeah,
good.
me too.
Now, before we go, okay. We just wanted. There's just something rookie. Rookie, if you don't mind, I can't. What's going on?
Is
here?
that the Doppler radar or something?
That looks like my outdoor TV right now.
Oh wait! No, rookie was trying to do something.
Was that
He wants
Trevor
to show
trying to share the
something.
screen again?
No, it wasn't Trevor this time. It was Rookie. I don't know what's going on.
I'm kind of scared.
Like,
What's this going to be?
No,
It's not playing.
He
Give
wants
Give
me
him
a
a
sec.
sec.
It's something to do with probably a Leafs thing or something like that. But it doesn't matter. Just we'll wait, and then we'll
Yeah, because the Leafs are important.
They are.
They are important. Excuse me, 100%. They are everything. They
They're
are my
top-rated
everything.
television all the time. More people care about the GM replacement than the Stanley Cup right now.
Yeah,
When
true.
you watch, that's when they lead off. It's funny.
All right.
Do you have any
End of the
questions
day,
of
while
us?
we wait for that to get queued up, the reverse mortgage is a fantastic product. HomeEquity Bank has a large lending area, bigger than their competitor does.
New
They're,
Zealand.
again, with 37 years of experience in the business, they know the market, they know what they can do, where to push the envelope. If it's a matter of giving the client, can we give the client an extra $10,000 on this deal to make it work and to put them in a better position? Are they comfortable taking that risk? Right. So
We want to extrapolate on the acronym CHIP. Canadian
Home Income Plan.
Right? So income plan, right? So part of it is structured to create income for people.
Absolutely.
Tell Rookie it's more than a sec. This is like a minute now.
Hi, here we go, buddy. We're just walking in. Is that?
I think he got close.
I think he got closest to the pin. He got closest to the pin.
Trevor got a hole in
Congratulations.
First.
Did he
ever.
buy the whole clubhouse of beer after that?
No, I
No,
told
the
Dylan
cheap
Parnell to
seat.
keep his
Cheap
mouth
bastard.
and just drove away or whatever.
Hey,
Shit, he went out the door right away. He didn't care. He's like, boom, God, car.
on. Let's
Just so you know, Trevor, closest to the pin doesn't count if it's in the cup.
Well, they told me to mark it down. So there was the hole-in-one hole had a $10,000 prize on it. That was 164 yards. I did not get a hole-in-one on that one. I got it 18 on Rockaway, 126 yards.
Ran out the door and got out of there as quick as he could.
But it is a difficult shot because it is over water. Right?
Over
it's
water,
not
yeah.
an island green, but it is over a big body of water. So it's not an easy shot with a
No,
water. So
can't
it's quite
believe
impressive.
first ever hole-in-one. And the funny part was the night prior, Nate was asking me like, Dad,
His little boy.
have you ever gotten a hole? Yeah, 9 years old now. Have you ever gotten a hole-in-one? Nope, I've never gotten a hole-in-one before.
You should tell him, have you ever won the lottery before?
Yeah,
say
ask
that.
the
Well, he's
question.
asking the question. So that, okay, sorry. So instead of digressing there, my comment, I did not buy everybody around, but I did tell Dylan, because Dylan was like, get me a drink or I'm announcing it over the PA. Said,
Oh.
fine.
So you knew.
I knew. So I also said to him, unless you'd like to give me the 10 grand from the hole-in-one hole, and then I'll gladly buy everybody around in here.
Yeah.
You still wouldn't have. You still would have taken one off.
No.
Yeah.
If I to spend $1,000 on everybody in the room, if I just won 10 grand,
I'd
share the
happily
wealth.
spend
right?
But you want the
$1,000 if I got a
10
whole
grand
one.
first. It's about cash flow, right?
Yeah.
Yes, exactly.
Try to forecast what you're gonna have right down the.
Well, I was assessing the risk,
That's it. That's it.
right? Money's just the byproduct.
Thank you very much for coming on. I'm sure
Yeah,
we're
guys,
gonna.
thank you very
really
much. Very
appreciate it.
educational.
Thank you.
you.
Had a great time.
It
Curry,
was so much fun.
Curry, did you set something up with Sink and Lich?
Not yet. No. Not
Okay.
yet. So, but that'll happen pretty soon, hopefully.
Okay. Do we have
Um,
anything going for our guests right now currently?
Oh yeah, we can get something for our guests for sure. Yeah, we'll get.
We
that.
have a sponsor, Brand Boulevard, Sink and Lich, so they.
Oh, Bridge and
Well,
Quarry.
that Bridge and Quarry there too, so they've got
I
a little
think
something that we get.
you
to
know
our
what,
guests, so we'll get
Rookie,
it
I
up
want
there.
you to put up here. And this is my own thing. I think it's time we get a new logo. I don't like our logo. We need a nice new, sexy, professional, inside-looking logo that we can get some Yetis.
Hey, I worked hard on that logo.
Well, put it up. We've had it for 6 years now. Rookie, say, put a poll up. Do you think it's time for a new logo? I want to know that. I want our audience to tell us because time for an upgrade.
Okay.
I don't style my hair like that anymore.
We have way more
All right,
gray in
well,
us too. Way
help
more
us.
gray in us now too.
Help us help you stay informed.
Ciao.
Bye.